Hi there. So in this video, we're going to be looking at savings plans, investments, and stocks. And I will go ahead and draw your attention to this notion up here at the top that I'm looking at retirement accounts here on this front page. And depending upon when you're watching this video was recorded in 2024. So the numbers that you see here in terms of the contribution limits for traditional and Roth IRAs, as well as the 401k down at the bottom, these are all as of 2024. But just to let you know, how did I find out this information? I just went to Google and I said, what are the contribution limits for traditional IRA versus a Roth IRA? So, if you're watching this, several years from now, and I haven't updated this video yet, then you can just Google, like I said, just Google what are the contribution limits for a traditional IRA, and it will tell you. I will tell you this, that it's been trending about that they would increase it by $500 each year for the past couple of years. Um, You'll notice in this top square, traditional versus Roth IRA. And by the way, IRA stands for individual retirement account. So it's just an additional way for you to set aside money so that you are have something to pull from whenever it's time for you to retire. Especially in the cases where your employers do not offer a pension, and pensions are becoming harder and harder to come by. All right, so here at the top, this first box is the same for traditional versus Roth IRAs. The contribution limits are $7,000 a year or $8,000 a year if you're over the age of 50. So they say that if you're closer to retirement, they'll let you put in a little bit more. The biggest difference between the two IRAs is the taxes. Traditional IRAs are pre-tax now, meaning you put in your money and you're not paying any taxes on it now, but when you go to take out the money in retirement, you will be paying taxes. The Roth, on the other hand, is that you're paying your taxes now so that then you can withdraw tax-free. It doesn't matter. I mean, it's totally, it's totally preference to you, but taxes are unavoidable. Okay. Um, Traditional IRA, you can begin withdrawing at age 59 and a half versus a Roth, you can withdraw at any time. And traditional, you have to start withdrawing by age 72. Roth withdrawals are not required. And as far as leaving money to your beneficiaries in a traditional, they're going to pay the taxes. Like I said, taxes are unavoidable. With a Roth, your beneficiaries can spread out those withdrawals over many years. A 401k is another way to prepare for retirement. So many employers will offer you a 401k, and on top of that, a lot of employers will even match up to a certain percentage. So for example, if your employer says, well, if you participate in the 401k, we'll match up to 6%, then as soon as you can get yourself to contributing 6% of your salary, it will definitely benefit you greatly if you can get up to that 6%, because know then that your employer will be matching that 6%, and that really helps your retirement grow a lot quicker. Um, 401ks, you can borrow from them and repay yourself back. It's like taking out a loan from yourself essentially, but interest is charged. Maximum contribution at the moment is $23,000 per year, but again, that's a number that keeps ticking up as years go on. 401ks are also pre-tax, so you're going to get taxed when you go to withdraw. You have to begin withdrawing at age 59 and a half, and I'm sorry, you can begin withdrawing at age 59, and you have to start withdrawing by age 72. There are levels of investment that you might choose to sort of set yourself up whenever you go to set up your 401k. If you're very young and retirement is far into the future, then you can afford to set yourself up in an aggressive manner, so that then that way you have more time to kind of play with the money in quotation marks there, but it also allows you, is you'll hear me say this later on in the set of notes, high risk, high reward. Okay, and so you'll typically in that aggressive one, you're involved more in the stock market because there's a high risk, higher reward though. Moderate, when you're getting closer to retirement, they might back off some of those stocks, for example. And then conservative, when you're getting closer to retirement, they'll stick you probably closer into more cash, less risky funds. Okay. I'll say this also about a 401k plan. Even if is your very first job, if your employer offers you a 401k plan, take advantage of it. I will tell you this: when I got my first job, I couldn't put away a whole lot, but I did. And as years went on and my salary increased, and for example, in your case, maybe as years go on, your salary increases, you get promotions, then you can start increasing the amount that you're putting into that 401k, and you will definitely be glad later that you did that. So just a little plug there. All right, so I'm going to flip us on over, and we are going to look at what's referred to as the savings plan formula. And so this can kind of help you see how much a particular amount, a monthly payment amount, could grow to if you were to invest it. So here's our formula here. A stands for your maturity value, the final amount that's going to be accumulated into that savings plan. PMT stands for the monthly payment that you plan to devote to that account. R is your interest rate. It's got to go in as a decimal, so take that percentage and divide it by 100, or move your decimal 2 places to the left. Time is always in years, and N is the number of payments in a year. You'll notice these 12s here in the formula. These 12s, I could have replaced that. That's actually where the N would go. I put 12 in there saying that we were going to make a monthly payment, okay? In other words, you could say, oh, hey, I'm only going to contribute once a quarter, for example. So then you'd put a 4 there. But I went ahead and put the 12 there saying, hey, we're going to contribute monthly. So that's just a heads up there. All right, so down below here in example 1, I'd like for us to do example 1 here together, and I'll let you pause the video and try example 2 on your own. So in part A here, it says, use this savings plan formula to compute how much Kim is going to have in her IRA when she retires at age 65. Her IRA is offering an interest rate of 6.25%. She started her IRA at age 25, and she plans to deposit $50 a month into that account. Okay, so I'm going to go up here to my formula. So A equals, come on the line here. So the monthly payment, she's going to put $50. I'll put that 50 there. Now, your calculator most likely doesn't have a bracket and a parenthesis. Just use double parentheses. 1 plus your rate, put that in as a decimal, so I'm dividing by 100. That should land you at 0.0625. Divided by 12. Close parentheses. You're going to raise it, and that's usually in your calculator, that's usually the caret button, or maybe you have a Y to the X or an X to the Y button. You've got one of those 3 buttons typically in your calculator that will raise it to a power. Parentheses 12 times. T is the number of years. She started contributing at age 25. She wants to retire at age 65. So she's going to be contributing for 40 years. So 12 times 40 up there. Close parentheses. Minus 1, close parentheses, and then divided by, parentheses, your rate, 0.0625, divided by 12, close parentheses. I've said this before, you should be able to type this in your calculator all at one time, get your final answer, and that should put you at $106,595.63. That would be our final answer there. I definitely encourage you, pause the video here, just make sure you can put this in your calculator. One other thing that I'll say that I didn't mention there whenever I was saying that about putting in your calculator, so your 50, 2 parentheses, 1 plus your rate divided by 12, close parentheses, then you're going to raise it to the 12 times 40, close parentheses. Some calculators are going to keep you up there in the exponent, so sometimes you have to hit the right arrow to get yourself out of the exponent so that that minus 1's not up there in the exponent, then close parentheses. Since I just want to make note of that. But anyway, that should land you at a little over $106,000. So now if we scoot on down here to part B, we want to think about then, well, how much money did Kim deposit into that IRA? So she was putting $50 a month. Think about that. She was contributing $50 per month for, and we're going to talk about this, so we did it for 12 months each year. For how many years? 40 years. This formula, by the way, is on the back side of your formula sheet. But if you look at it here, I'm going back to our very first unit. Our months cancel out, our years cancel out, and the only unit I have left is money. In my calculator then, 50 times 12 times 40, nothing fancy. She put in $24,000. That money, though, grew to $106,000. So in part C, it wants to know, well, then how much money did the IRA earn for her? Hopefully you agree then. I'm just going to take these two numbers here and subtract and that's going to tell me how much the IRA earned for her. In our case here, that subtraction, $82,595.63. Final answer. Okay. Now, I mean, she worked for 40 years. She could have even done a whole lot better for herself here. This is under the assumption that she was only contributing $50 a month, whenever she started at age 25. But like I mentioned to you just a few minutes ago, let's say after 5 years she's gotten herself a raise. Well, maybe she upped that to 75, and then at the 10-year mark she said, okay, well, hey, I can start doing 150 down, and she can, as she increases this monthly payment, this overall number here obviously is going to get a lot higher for her, and she's going to see a lot higher return. Okay, so just a just a little, little food for thought there as well. Okay, all right, I'm going to let you pause the video and try example 2 on your own, very similar to that one that we just did together. I'm going to flip it on over. All right, so now on this next page, I want us to think about then, well, suppose that you've got in mind that you want $700,000 whenever you retire. How much money then do you need to be depositing each month to reach that goal? Okay, so essentially what this formula is here at the top then is it's just a manipulation of the formula on the previous page. Our A still stands for the final amount that you want to have in that savings plan. Your PMT is still the monthly payment that you would be putting in each month. R is your interest rate in as a decimal. T is time in years, and that N is the number of payments in a year. And again, I've already made that 12 because we were assuming that we were making monthly payments. All right, so I'm going to do example 3 here with you, and then let you try example 4 on your own. So it says here that supposedly you're currently 35 years old. You want to start with saving for your retirement. If your investment plan pays an APR of 6%, and you want to have $1 million when you retire in 30 years, how much should you deposit monthly? So I'm using my formula up above here. What kind of payment should I be putting in each month? So your payment is equal to A, the final amount you want. So you want $1 million. Your rate, taking that 6%, dividing it by 100, so 0.06 divided by 12. Close it, divided by 2 parentheses, 1 plus that rate, 0.06 divided by 12. Close it, raise it to the 12 times T, how many years? You want to retire in 30 years, so times 30. Close parentheses. Again, like I said, if you need to get out of if you're still in the exponent, use your right arrow key to get yourself out of the exponent. Minus 1, close parentheses. Then you should be able to hit enter, your equals mark. Definitely try this in your calculator. Make sure that you can get $995.51. So if you wanted to reach that particular goal, knowing that you have this interest rate, you would need to put in, almost $1,000 a month to be able to reach that goal. Okay. All right. I'm going to let you try example 4 on your own. I'm going to come down below and pick up the next 2 formulas at the bottom of this page. It's leading you in here that, in your previous examples, we've assumed that our interest rate has remained consistent for the entire time period, but in real life, that's not the case. Interest rates fluctuate over time. So to figure out, kind of a good way of figuring out, whether, what our total and annual returns are, we have formulas associated with that. You consider that your investment grows from an original principal, P, all right, so P is how much you start with, to an accumulated balance, A, so A is always your final amount. Your total return is your the percentage change, okay? So your total return is always going to be a percentage. It's going to be equal to your final amount minus your starting amount divided by that starting amount times 100. This is very similar to that formula that we had before, new minus old divided by old, back in that first unit, I believe. Your annual return is your annual percentage rate that would give the same overall growth for T years. Annual return is equal to your final divided by how much you started with, raised to the 1 over T minus 1 times 100. So let's flip it over. On the next page, we'll demonstrate those two formulas, how they play out. So I will do example 5 with you and then let you try example 6 on your own. So here in example 5, it says that you invest $3,000 in Clearwater Mutual Fund. Over 4 years, your investment grows in value to $8,400. What's your total and annual returns for this 4-year period? All right, so let's come back here and let's identify which is our A and our P. So remember, P is how much you started with. So you started this account of a purchase of $3,000, and then after 4 years, it had grown to a final amount A, $8,400. Okay, so in the first part here, what's our total return? So I'm going to do A minus P, so 8,400 minus my initial point, 3,000, divided by 3,000 times 100. Now you can use all those parentheses here, but this particular formula, I personally don't really use those parentheses because if you think about it, if we just subtract up top, that's going to give me what, 5,400? Then I don't even need parentheses because I can type this into my calculator all at one time. 5,400 divided by 3,000 times 100. We'll do, I don't, actually, you should be fine. It comes out perfect, doesn't it? 180%. So this means that over 4 years, your investment increased by 180% of its original amount. And if you think about it, you started at 3,000. If it doubled, that would have been 6,000, right? And so, and that's a 100% increase. And so we know it had to be more than doubling. And if it tripled, that would have gone to 9,000. And when something triples, that's a 200% increase. So it didn't quite triple. So this 180% at least makes sense. Those are some just, remember, whenever you doubled back in a previous unit, that was a 100% increase. When you tripled, that was a 200% increase. So we can see here that, okay, it should have been over 100, but not quite 200. And sure enough, our math checked out and we were at 180%. All right, I'm going to come down here for our annual return. How much would we expect for to get back each year? And again, this takes into account our fluctuations in interest rate. All right, so here I will use my parentheses here. I am going to do double parentheses, A final amount, so 8,400, divided by initial 3,000, close it, raise it to the 1 divided by T, so this was 4 years, close it. Again, if you need to get out of parentheses, get out of the exponent, use your right arrow key, -1. That won't apply to everybody, but some folks it will. Times it by 100, and that should land you, we'll do 2 decimal places here. Make sure that you can get 29.36%. So this means that your investment would increase by an average of 29.36% each year. Sometimes a little more, sometimes a little less, but this is your overall average. All right, I'm going to let you try example 6 on your own utilizing those two formulas and check yourself by the solution key. We're going to move down into the last half of this section talking about investments and more specifically also your stock markets. So there are 3 types of investments. There are stocks, and so that's whenever you take ownership, purchase shares, which is ownerships into a company. Stock prices can change, so therefore your sale could result in you getting a gain or a loss depending upon how much you originally purchased shares of those stocks. A bond is a promise of future cash. They're usually issued by a government or corporation, and they pay simple interest. Okay, and then cash investments are deposited into bank accounts. They could also be CDs. CDs are very common, as well as treasury bills and cash investments. And if you don't know what I mean by CDs, like I said, they're referred to as certificates of deposits, but they generally yield you a higher interest rate than a typical savings account at your bank. And so they can be helpful in that, if you're depositing into your savings account and maybe your savings account's only giving you 2%, but you could get a CD for 4.5%. And some of them have gotten up even over 5 and 6%, for example. The only difference though is that with a CD, you take it out for a period of time. So, for example, you might purchase a 6-month CD, a 9-month, 1 year, 5 years. Depending on you take it out for a particular term. You take it out though. Let's say you take out a 6-month CD and they're giving you 4.5% interest rate. If you happen to need that money prior to that 6-month term being taken out, you're going to take a penalty for having to withdraw that money prior to the end of the 6-month term. But if if you don't need that money for that full 6 months, then you have gained yourself more interest than you would have gotten otherwise in just a typical savings account. Okay, and typically the longer the term for a CD, the higher the interest rate. That's not always the case, but typically it goes that way. All right, so there are some things to consider whenever you are trying to figure out what type of investment is best for you. The first is liquidity. And that refers to how difficult it is to get your money get to take out your money. For example, your bank account, as long as you have money in it, is very liquid. But if you own your house, while you have money that you can get out of that house, it's less liquid, right? If maybe you need to sell it, for example, or um, then you've got to wait for a buyer to come along and to go through the whole sale process before you can get your hands on that money, for example. So your bank account is very liquid, but your house, for example, is a lot less liquid. Same thing, a car. If a car is something that you own, then, if you wanted to try to sell it, it's less liquid than your bank account. You can get money out of it, but you gotta find someone to buy it first, right? Risk is the money that you have at risk. Typically, and like I said, you heard me say this before: low risk, low return; high risk, high return. For example, your bank account is a very low risk, but it's also a lower return in a typical savings account. But a investing in the stock market is a higher risk, and as long as if you choose good stocks, then you can have a very high return. So high risk, high return; low risk, low return. Returns are how much you can expect to get on your investment. No one has a crystal ball in order to be able to predict that. But what we typically, if you went to sit down with a financial advisor, though, for example, they would base it off of historical trends. And if you flip it over to the next page, you can see the average annual returns for stocks, bonds, and cash. So I'm going to come down below and I'll get you started here in example 7. I'll probably just go ahead and end up working through this one, and then we'll move into our stocks. So here in example 7, it says that your great-great-grandmother invested $100 at the end of 1900. At the end of 1900. So $100 in 1900 was a lot of money. And each of these three funds listed above. So she put $100 in stocks, $100 in bonds, and $100 in cash. And then we're going to assume that her investments grew at rates that were given above here. Approximately how much money then would each investment be worth at the end of 2012? We're going to use our compound interest formula to calculate each final amount. So remember, get you started here, like I said. So we'll start with stocks. So remember your compound interest formula. A equals your P, how much you put in. So she put in $100. 1 plus your rate. So for stocks, 0.063. And I had said here you're going to compound once per year, so divided by 1, raise it to the n times t, so 1 times how many years? She invested in 1900, and we want to take it out in 2012, so that would be 112 years. Excuse me. So you should be able to type that in your calculator all at one time. And after 112 years, that $100 would have grown to $93,696.99. Okay. All right, let's move to compare that to investing in bonds. All right, so for our bonds, she still put in $100 into this account. 1 plus your rate, so 0.02 divided by 1, because it's going to be compounded once per year, raised to the n, which is 1 times 112 years. Again, you should be able to put that in your calculator all at one time. That $100 under bonds would have grown to $918.80. So big difference there. And then lastly, let's move to cash. All right, so for a cash investment, still put in $100. 101 plus the rate there. So 0.9 divided by 100, that's going to give you 0.009 divided by 1. Raise it to the 1 times 112. And that would grow to $272.78. So this also gives you a good idea of higher risk over here with stocks, high return, cash, low risk, low return. And again, you never know. I mean, if you, for example, you choose a stock and a stock gets some bad press, somebody, the president of the company or somebody does something, a stock can plummet in an instant. So just so you're aware of that. And I make that note here. Even though the stocks are showing the best long-term investment, that's not always the case, depending on the stock itself, for example. All right, so we're going to come down below, and I want us to take a look here. We're going to look at the Microsoft stock printout. This is a stock printout that I printed out from Yahoo. And I want us to, here on the front page, just get familiar with some of the terminology based with this stock. And then on the next page, we'll answer some questions in regards to the same stock printout. All right, so the first one is the ticker symbol. And the ticker symbol is used to represent the stock itself so that they're not writing out Microsoft each time. Or if the target was McDonald's, you wouldn't write out McDonald's each time. It would have an abbreviation. That abbreviation, and as we go through this, I will come up here and I will note them for you. So we're talking about the first one, which is your ticker symbol. Microsoft is right here, MSFT. I'm going to cover it up. There we go. That's the ticker symbol there. Number 2 is the current price. So that's the current market price for each share if you were to purchase it. And so that's gonna be that big number here. All right, so I'm gonna label that. That's number 2 there. The share volume, and that's the number of shares that have been traded so far today for the company. It's just labeled up here as volume. Okay, so that's your share volume. Shares outstanding, that's the total number of shares that exist for the company, and that is not there. Okay, that is not listed in this printout, but if you come down to number 5 is talking about the market cap, and market cap is given to us, so we'll note that up there. But notice what the market cap utilizes, or the formula for market cap. Market cap is the total stock value of the company. I just abbreviated here MC for market cap. Your market cap is equal to the total number of shares outstanding times the current price per share. So think about what this printout gives us. It gives us the market cap and it gives us the current price per share. So we can plug in those two pieces and solve for the total number of shares outstanding for our company. And then lastly, in number 6, it wants your giving you a dividend or current yield, and that's the yield, annual yield to shareholders based on the current price per share, and that is this guy here in parentheses. So if you were invested, for example, in Microsoft, you would get payouts. You can choose to have those payouts, then actually cut a check for you, or you can just have it set up so that you are purchasing more stocks in the company and just reinvesting that amount. Okay. All right. So let's flip it over. This is the Microsoft again. This is that same Microsoft printout, stock printout, and we are going to come down here and answer questions in reference to this printout. All right. So I'm gonna do just like I did before, except these are down here noted as A through F. So as we go through them, I will note them as A through F. All right. So in part A, it says what's the ticker symbol for Microsoft. So back up here at the top, there's our answer for letter A, that MSFT. Part B, current price per share when this report was generated. So come back up here. Remember, that's that big number, Bolton. All right, so that's the $150. $1.82. Part C, what was the price per share at the end of the day on the previous day? Come back up here. You've got a couple of ways that you can find that. You can just go simply to previous close, and that would be where I would recommend that you go. Or if you notice here, this up here beside the $150.82, it has that plus sign, $1.24. It's saying that that's up $1.24 from the previous day. So you could take the 150.82 and subtract $1.24, and that'll also land you at 149.59. No, actually that one would not. This one must not be this must just be not a perfect day. Let's see. Make sure I'm telling you right. Yeah, because it's 149.58, so it's real close, but it's not quite spot on. So I would recommend let's go by that previous close. This must be as a real time up $1.24 as opposed to up $1.24 from the previous day, for example. It's my guess at that point. All right, so I'm gonna come down here and I'm gonna use that previous close, 149.59. All right, so now in part D, it says using the market cap and the current price per share, let's estimate the shares outstanding. And I'm just reminding you here, the shares outstanding are the total number of shares that exist for the company. And I've got us, because we're talking about the number of shares, we're going to round this to the nearest whole number. So the first thing I'm going to do is I'm going to remind you of your formula that from the previous page, that your market cap is equal to the number of shares outstanding, I'm just going to do a little bit of abbreviating, shares outstanding, times your current price per share. All right, so a couple of things then that we need. We already know our current price per share. That's the 150.82. But we need the market cap, and the market cap is sitting right here. So this was letter D. Let's put a D there, okay? That 1.151 trillion, okay? Because you got a T back there. All right, so for my market cap, so okay, since I got trillions, I'm going to kind of do myself some placeholders here. So I got ones, tens, hundreds, thousands, millions, billions, and then I got my trillions. So it's 1.151 trillion. Everything else then will be zeros. Number of shares outstanding, we don't know. But we do know the current price per share, 150.82. A couple of steps here then to find my X, the number of shares outstanding. Always divide by the number beside your letter, so divide both sides by the 150.82. Cancels out here. X equals, so after you do that division and you're rounding it to the nearest whole number, 7/6. And we'll box that in. That is the total shares, total number of shares that exist. Okay. In part E, it says, what percentage then of all Microsoft shares have been traded so far today? So if you remember back on the previous page, your volume was the amount that had been traded so far today. So your volume, so come down here, this will be my letter E here. The volume is the amount that's been traded so far today over this total number of shares that exist. So I'm going to put the part over the whole. So it wants to know again, it wants to know what percentage of all Microsoft shares have been traded so far today. So that's going to be your volume divided by your shares outstanding. I'm just going to abbreviate there, shares outstanding. Because remember, the volume represents the amount that's been traded so far today. The shares outstanding are the total number of shares that exist. So there's your part and your whole. So the volume is back up here on our printout, that 4,822,504 divided by the answer that we just got there, that 7 billion number. Oops. Multiply that times 100 because we're trying to find a percentage here. It's a very small percentage. Should land at 0.06%. Okay. And then lastly here in part F, suppose you own 50 shares of Microsoft stock. Based on the current price and the current dividend yield, what's the total dividend you'd expect to receive this year? So I'm going to come back up here. Our dividend yield here in parentheses at 1.36%. All right, so the first thing we need to figure out, what's the value of our shares? So to figure out our value is equal to the current, well, how many shares we have, times the price per share. So in our case here, it tells us that we have 50 shares times the current price per share, that 150.82. Do that multiplication. We've got $7,541 worth of Microsoft shares. You would then get a payout, total dividend of the 1.36%. So I'm going to take my 75.41 and multiply it times 0.0136. And we're talking about money, so we'll just do dollars and cents. $102.56. Final answer. All right, that finishes up this section. Thanks a lot. Bye.